And what that means is when your short-term treasuries demand more interest or in payment than your long-term, it means people see short-term trouble ahead, i.e. recession. This is the strongest recession indicator we have, and it's been flashing recession here for months and months and months. So we know that 2023 should be the year of the official recession, although we're going to have to. Hey everybody, this is Rob Kientz with goldsilverpros.com. We're at April 7th, 2023. It is about 12:30 Central Time as I'm recording the video, and this is your weekly market wrap-up. Very interesting week to go over, so we're just going to dive straight into it. I wanted to start off with the gold price. We had a nice little rally in gold and silver this week on news of the banking crisis, as well as word about what the Fed may do with interest rates, as well as labor market weakness. Gold looks like it's going to end up over 2,000 for the week. It's sitting at 2,779 after starting the week in about the mid 1970s. Silver's at 24.97, down 2 cents on the day, but hovering right around that $25 mark, which, by the way, is higher than critical resistance at 24.50. If silver closes the week above 24.50, I think it's fair to say that silver is in a really strong bull market and probably will not slump down too much in the near future. We'll have to take a look at what goes on in the economy to determine what will happen with gold and silver. But a very nice little bull run for gold and silver. I expect the pullback as traders begin to assess what's going on in the economy and kind of sit back and see what's going on before they change their gold and silver positions. So we could see a little bit of fade in the gold and silver price until the next big batch of news comes out, but we'll continue to track it. Looking at the economic news, not a lot to report, although a couple of big things. Manufacturing is still down. The PMI is at 49.2, the S&P final US for the whole country, and anything under 50 is generally considered bearish or shrinking. It's slightly under 50, but it's not growing. The ISM manufacturing survey came in at 46.3%, and construction spending was down 0.1%. Factory orders down 0.7%. On the jobs front, we had a bunch of news come out this week. Job openings fell to 9.9 million. There are not enough job openings for the people that need work. ADP unemployment report came out Wednesday. It reported a creation of 145,000 jobs. That's slightly less than half of what we saw last month at 242, and economists expected it to grow and us to get 261,000 this month. We only came in at 145, about 116 below expectations. The final PMI for the services industry is 52.6. So services is growing a little bit. Manufacturing is slumping. And back to employment, the jobless claims were up at 228,000, although less than last month at 246, higher than expected at 200. Continuous jobless claims remain sticky at 1.82 million. Those continued jobless claims are up 0.13 million from last month. I believe it's 1.69. So joblessness is getting worse. The overall U.S. employment report, they're calling it now, the non-farm payrolls came out with 236,000 jobs. It's quite a bit more than the ADP unemployment report, which is typical. I tend to believe more the ADP because it's based on payroll data, but nonetheless, that's the government's figures, 100,000 less than last month. So we're not looking particularly rosy on the labor market. Turning to the average or the regular markets, the Dow futures are trading at 33,723, up 64 points on the day. S&P is up 9 points on the day to 41,4150. NASDAQ is up 13 points on the day to 13,184. Oil has gone up recently. A big story, OPEC cut production. I think it was something like 1.6 million barrels a day or something along those lines. That has caused both WTI and Brent crude to rise, which is going to cause more expensive energy inputs into the markets, which I expect will affect the markets. The cryptos had a pretty good run, but they're down this week. Bitcoin today is down 88 bucks. It's trading at 27,945. The whole Bitcoin crypto complex is down, although they have made a nice run the last few weeks. So we'll continue to watch that. I think they've made a nice run like gold in response to the banking system issues that we've had in the country. Bonds were quite a bit schizophrenic. They went down quite a bit on the banking crisis because I think that the market expected the Fed was going to start easing again. The Fed is not going to ease. They've kept up the talk about tightening, but tightening at a slower rate. And so the bond rates have started to rise again. We're sitting at the 2-year right under 4%. It's 3.993. It's up 0.172 points today. The 10-year is at 3.413, which is lower than the 2-year, which means we have higher short-term rates, which is a yield curve inversion. And what that means is when your short-term treasuries demand more interest or in payment than your long term, it means people see short term trouble ahead, i.e., recession. This is the strongest recession indicator we have, and it's been flashing recession here for months and months and months. So we know that 2023 should be the year of the official recession, although we're going to have to give it a couple of quarters to see for when they call it. As I said earlier, one of the big stories of the week is OPEC cutting production, and that's really going to affect the worldwide oil market. Brent crude gapped open at $85 a barrel. West Texas Intermediate moved above $80, and the spread is trending towards $3. It's a good news, however, for U.S. producers and exporters. The oil market had a fundamental supply and demand mismatch. Back in January, even the International Energy Administration, was talking about a nearly 1 million a day mismatch between supply growth and demand growth. Supply growth was falling 1 million barrels a day, and demand growth is growing 2 million barrels a day. And that was with a recession on everyone's mind. And now OPEC is cutting. So that's really going to affect supplies of oil in the market. Expect oil price to continue to spike. Oil is a huge input into the economy, so that probably will have negative effects. We'll follow and see if we can track those effects as time goes on. The other big story, especially for people that are fans of JM Bullion and my great state of Texas, is that Texas has put a bill in both the House and the Senate that would create a state-issued gold-backed digital currency, ladies and gentlemen, as an alternative to the central bank digital currencies. It says here on an article on Zero Hedge, bills introduced in the Texas House and Senate would create a state-issued gold-backed digital currency. Senator Brian Hughes, Republican, introduced Senate Bill 2334. That's SB 2334 on March 10th. And Representative Mark DeRazio, Republican, introduced a companion House Bill 4903, that's HB 4903, on the same day. And that legislation would require the state comptroller to establish a digital currency that is fully backed by gold and fully redeemable in cash or gold as well. And the comptroller would also be required to create a mechanism to use this gold-backed digital currency in everyday transactions. A quote, "In establishing the digital currency, the comptroller shall establish a means to ensure that a person who holds the digital currency may readily transfer or assign the digital currency to any other person by electronic means. The state of Texas would hold gold back the currency in trust on behalf of the digital currency holders. It could be in the Texas Bullion Depository or in another safe depository of Texas choosing." Another quote, "The trustee shall maintain enough gold to provide for the redemption of gold in all units of the digital currency that have been issued and are not yet redeemed for money or gold." And this is seen as a direct competition to central bank digital currencies. As you know, we've been reporting that central bank digital currencies are coming out, but China and Nigeria have rolled theirs out. Nigeria on an exclusive basis, China more on a trial basis alongside their existing system. Although they did do some things in the banking sector to kind of force people over to it, especially in rural areas. We reported on that this week. Those experiments haven't been going off terribly well. The United States, through the Fed, the central bank, is doing Fed Now, which they say is not based on blockchain, but it looks suspiciously by one. I've had some people tell me XRP. I cannot find confirmation, but the billing fee structure and the facility of the Fed Now system looks like it's built on blockchain. We'll have to see if they fess up and admit that at some point in the future. But Fed Now is the precursor to what eventually will become the digital dollar. That's in trial stages here in the United States, and I would actually say testing and trial stages. So a little bit earlier stage development in the United States than in China and Nigeria, but obviously the central bank digital currencies are coming. The states are utilizing Article 1, Section 10. No state shall make anything but gold and silver coin and tender in payment of debts in the Constitution, as well as the 10th Amendment, which basically states all laws not specifically outlined in the Constitution belong to the states and the people. So the states are there exercising their authority to issue a state-backed currency backed on gold and silver. That's constitutional in the U.S. Constitution, and they would just put a digital currency on top of it. Very, very big news, given the fact that we know the dollar is probably on its way out, and we know that there are alternatives being developed at the federal level, not only in the United States, but other countries. For a state like Texas, the 800-pound gorilla, a big boy in the United States, to come out and say, well, we think, we may want to go a slightly different way. Let us first set up a depository and then introduce bills that would make gold and silver legal tender and back it by digital currency so people can use it every day and don't have to carry gold and silver around, therefore eliminating the potential robbery problem or the home invasion problem. Gee, I don't know. If I wanted to go to the legislature and suggest to them that they set up an alternative currency system, I might tell them to do it exactly like they've done it. the state of Texas has done a perfect job in the way that they've set this up. And I think Texas may be one of the first states that gets a gold-backed currency. We'll see. A gold-backed digital currency. We'll see. Here to the gold chart on the CME Group's website. Volume has come down now that we're in April. There have been some deliveries. We'll look at those. There's 186 deliveries on yesterday's data. There's a whopping 406,000 contracts trading on the June contract. That is definitively the contract of choice for traders, although you can already see people moving out of it. 2,066 contracts have started to move down to these months over here, but by far June is still the dominant month. You can see that there were 1,378 contracts of 100-ounce gold on Thursday that were EFP'd or transferred over to the London market. That's what EFP means, exchange for physical. It's privately negotiated and simultaneously exchange a futures position for a cash position in the London market. If we look at Wednesday's data just to see what trading went around, we had a whopping almost 7,000 contracts move from the COMEX to London. We've seen this trend as we get in these weaker delivery months on the COMEX, because remember, you can only deliver in the current month. So there were 609 deliveries, but there's only 1,200 or 1,100 contracts open. So you could still get a good amount of gold delivered. You can deliver all those contracts, but look at how they're moving off into future months. So if you want to get delivery in this month, you better do it really quick. Well, what's happening when you can't get delivery in this month, what they do is move it over to London and get exposure there. Sometimes they're getting the metal. Sometimes they're just getting exposure to the gold in that market so they can exercise it, in a different month that they're in, but also allows them to get potentially exposure to the physical metal. And that's why in these weaker months where you don't see a lot of contracts, where you're going to have a lot of deliveries, you're going to see people pull forward potential deliveries and exposure to gold from the busy month, which happens to be June. And that shows up in the EFP column. And the way that they do it is go over to London to get that liquidity. That's what they're looking for. Only about 6 months on the COMEX every year are heavy delivery months, or heavier than average delivery months for the COMEX. You can deliver technically in any month, but if you don't have a lot of contracts, there's not going to be a lot of deliveries because you still have to use a paper contract to effect a delivery. So that's kind of how that works. Looking over at the settlement data on Friday, it's all blank. I think they just haven't filled out their feed. So we'll go to Thursday's data. Again, you can see June is a dominant contract month. Open interest, this is Thursday's data. So Wednesday's open interest is 408,000. Thursday's is 149, 129. Thursday, it closed down about $9 to 2026.40. That's where the price is determined. If we go to Wednesday, it closed down $2.60 to about 2035.60. So it was up all week and it's starting to fade. That's kind of normal when you have a really nice big pop in gold and silver. They will tend to fade a little bit afterwards, and we're seeing the fade in the data. That is not abnormal, ladies and gentlemen, so don't panic if you're seeing that. All right, now moving over to the ETF data. I show the ETF data every week because, one, it gives you a tabular format of most of the gold and silver in the world. This is the gold chart. This one over here is the silver. We'll get to that after we do a silver review. And it breaks it down into like jurisdictions. COMEX is all US. Most of this is in London, although some of it sits in the US and maybe other jurisdictions as well. Like in the SPDR, I think one of their depositories is in New York. The rest, I believe, are in London. But this is a sort of a good proxy for seeing what's going on in the London market as well. So if you look at this table, it kind of gives you the USA and then it gives you the London plus view, and that's why we do it. One thing I like to call your attention to, if you click on the total weight here, this clickable link of SPDR in this case, because it's the biggest ETF, we can get a nice little chart here on what's happened, and you can see it had, a lot of gold and came down. Here, silver squeeze came back down. And overall, the value of the gold held is going up, but the ounces aren't. That's because price is going up, but not a lot of ounces coming in. Most ounces are flowing out. Overall, in the last 4 weeks, we've seen a lot of gold flood back into COMEX. And in fact, last week is where a lot of it's come. You're looking at about 700,000 ounces, I think, that flowed back into COMEX. If you look at that chart, if you go down overall to the flow in the East and West, it's 1.9 million. So about 1.2 million of those really were flowing into the London market more than the US market. So that'd be about 1.2 million, about 700,000 flow into the US. That's how you read that chart. And overall, a nice healthy flow back into the depositories for gold and silver. And when they flow into these ETFs, that's a sign of generalist demand. That's why we watch these charts. So as we're having positive flow of almost 2 million ounces the last 4 weeks, it means people are putting money into the ETF. Why? Because they're interested in gold. Now, in these most of these ETFs, you're not going to get the physical gold. Some you can. In the big one, SPDR, you can't. Only authorized participants can. So a lot of the ETF is passive gold investing. and it's not easy to get gold out of a lot of these. Some have no gold redemption requirements. So it's just price exposure, this part down here. The ETFs are mostly price exposure, not a lot of physical delivery going on in those, depending on which one you're in. But they do give a good indication for passive demand for gold, and it's up, and that's a good sign for the gold market. Moving over to silver, something similar in silver, although we saw elevated trading in silver, I think, for deliveries. We're going to look at that data in a moment, especially the 4th of April, a couple, 3 days ago. We had a nice big spike in open interest. Looks like the peak for the month was on April 4th. May in silver is the dominant contract month. You can see 405 contracts have rolled out as of yesterday. They're starting to roll into July. So July is going to be coming up the dominant contract month for silver right now with 92,000 open interest contracts. It is May. You can see that about 425 went over exchange for physical to London, while 64 delivered on the current contract in April. So this is physical delivery April. These are contracts rolling over to London, either for cash exposure or potentially for the physical as well. That's Thursday's data. We look at Wednesday as well. Just give a 2-day snapshot. In May, again, dominant contract month. 2180 contracts rolled over to London, exchanged for physical. Only 11 were delivered. Only 84 contracts still open on April. April, not a big delivery month. And by going through these mechanics, what I'm trying to explain to you guys is how the market works so you understand. I know a lot of people don't care about the details, but if I do this enough times, people understand how the market works. You'll have a better idea when gold is going up and down. It helps you with your purchases and sales, your trading, or if you're just buying hold, that's good too. It gives you an idea of what your dollar cost averaging is. It gives you an idea where the market is, and it's really worthwhile to go through this data. So it's the first time you're seeing it. Please stick with it. It really does help us understand the market. I think it'll teach you a lot about the market as well, about the mechanics of how it actually works. Most of the data I'm going over here is all paper data. It's on the paper contract, a future contract, a paper contract. It's not on physical movement. We'll talk about physical movement here in a moment. The dominant contract month for silver is in May. You can see that 49,817 contracts currently open of open interest. As of yesterday's data, up 56 cents to close at 25.093 on the American market. If we move over here to the Wednesday's data, closed at about 25.037, down about 6.4 cents on 66,000 contracts at silver. Moving over to the tabular chart, you can see silver is still flowing off COMEX. It's been all red for a very long time. Almost 19 million ounces have flowed off of the U.S. market from registered and eligible. I'm sorry, 10 million ounces. So we got to look at the total. Then we go down here. Here's 14 million ounces flew off of London. So it's about an extra 4 million ounces in London as well on that side. So quite a bit, 468,000 million, total ounces in the biggest iShares SLV. And you can see how that's basically rolled off since silver squeeze. And even though silver has gone up, the total number of ounces has basically stayed the same pretty much all year long. And that means people are interested in getting physical silver. Last chart we're going to look at is the Commitment of Traders report from the CFTC. Whew, taking a breather. We're almost through the heavy part of the presentation, guys. The Commitment of Traders report, COT report, is put out by the regulator, the CFTC, upon them collecting data from the various market participants. That's right, they get it from the market participants. I claim that this means that they cannot properly monitor the market because they're getting data from the people trading it, but that's neither here nor there. This is the report as it is. And why we look at this report is for silver and gold to see how big groups of traders are positioning. We look at reportable positions, and you can see the big groups. You've got the producers and merchants lumped together in this column. You've got the swap dealers lumped together in this column. You got management. Swap dealers are the bullion banks, by the way, the HSBCs, the Banks of America, the JP Morgans of the world. Managed money are the financial houses, financial companies, anybody that's taking a financial position or a speculative position in the metals. Other reportables tend to be wealthy family offices and individuals. We're going to go down and look at the gold and silver chart. This is as of March 28, 2023. The Commitment of Traders report always comes out in arrears or looking backwards, and usually is late, anywhere from 5 to 7 days because of the day that they release it. But it does allow us to look back and see what happened over the previous week's data. Okay, so as we look at producer merchants, it makes sense that they're net short of about 26,000 contracts. They're long 30.24 and short 29,748 for a net of about 29,700 short. Why would they be short? Because on a futures contract, if you go short, you're saying, I expect prices to come down. A producer wants to protect against the price of silver going down. So he can't do that unless he takes a futures position and takes a short position. And if the price of silver goes down, he makes money on his futures position, his paper contract, as a form of insurance policy, which makes up for the loss he had in the real market. So, for example, let's say silver is at 24.97 right now, and 2 months from now, the miner finally gets the silver out of the ground. They go to market, and it's at 24.35. You lost 60 cents an ounce, 62 cents an ounce. But if he had had a short position on COMEX, it could have made him whole because he would have made money on the short position. He could then redeem that short position and make the money that way. Okay, so that's called legitimate hedging. This column are most legitimate hedgers are producer merchants. The rest of the guys, most of it speculative. They're just playing the price on the paper. If you look at the bullion banks, their net long of silver by about 4,800 contracts. Them being net long silver, I call them the smart money or the sharps. That means they think silver is going to go up, and it has been. That's why silver's been going up. They've been going long. The managed money is also long. They've been smart. I think they're listening to the program. They dumped, because silver went up, they dumped 9,200 short contracts last week and added 1,300 long. So net, they went long about 11,000 more, which put them net long about 5,000 contracts for the first time in a while. The wealthy individuals are also long. So everybody's long silver. It looks like everybody expects it to go up. Looking at gold, producer merchants are short 60,000 to 15 makes sense, guarding against downside price risk. The bullion banks are a more than 2-to-1 ratio short on gold, which means they're working to keep the gold price down. That did change a little bit. They added 13,000 shorts and dropped 1,800 long, so about 15,000 more net short this week than they were last week, meaning they're betting short on gold. They're betting on fade in gold. The managed money, the financial houses are net long about 4-to-1 on gold. They're expecting, with the financial problems, for gold to go up. I think they're well positioned for the long term, although in the short term, I think the swap dealers will make money on the fade. Other reportables, which are the family offices and things, are about 4-to-1 also. So a lot of the managed money and the smart individual traders are 4-to-1 gold. Everybody's expecting that to go up. And I do think it will, although I do think we'll have some fade in gold and silver because of the recent increases. And I think that depending on the news that comes out in the next month, whether gold and silver will go up. Are we going to continue to get some weak earnings reports? Are we going to have any more bank failures? How's the Fed going to treat the economy based upon the economic data? That's why we do the weekly market wrap-up, so we can cover this data every week and it makes sense of the market for you and tell you what's going on and give you a preview for next week so that you can have an idea of what the market's going to look like. All right, just to recap, gold and silver had a really good couple of weeks because the bank failures, they faded a little bit here to end the week, but they're still up and in a nice bull market, having broken through critical resistance that it was sitting at for quite a long time. Big stories were that OPEC has cut production of oil, which is causing oil to surge. And we already had a supply shortfall across the world of about, I want to say, was it 3 million barrels or something like that per day? Something along those lines, according to the article. And now they're cutting more. So prices are going to rise for sure. And also Texas State is put in a bill in both the House and the Senate, basically to make gold legal tender and to do a digital token on top of it, to make their own state-issued CBDC, but backed by gold and silver. So be an asset-backed digital currency. So be different from what the Fed may do with the digital dollar, what the Chinese are doing from the digital renminbi, and what the Nigerians are doing with the digital naira. So we'll have to see what happens in Texas there. It does look like, however, the states are exercising their states' rights towards money. And that's an interesting stance given the central bank wants to issue, or right now has Fed now wants to issue a central bank digital currency in the future. We'll have to see how that turns out and what the constitutional and legal battles will be. But the one thing I do know is going to be a lot of interest and a lot of excitement here in the next couple of months. We'll stay tuned to it and continue to bring it for you on the weekly market wrap up. Until next time, this is Rob Kientz with Gold Silver Pros.